Welcome to Corporate Insights webinar on our recent Fintech and Incumbent Banking Survey. My name is William Jack, and I'm the Senior Analyst on our Fintech Monitor here at Corporate Insight. Before we dive in, I want to highlight a clear opportunity. Our research shows that 50% of Fintech-only customers considered a traditional bank account before opening their Fintech account. However, a challenge also exists. Branches and personal service, which are long-standing strengths of traditional banking, matter far less to Gen Z consumers. This leads us to today's central question, which is how can incumbents transform their approach to win the next generation of banking consumers? In today's presentation, we'll explore survey findings that can help answer that question. So this is the agenda for today's session. I'll begin with a brief introduction to Corporate Insight and our Fintech Monitor service, walk through our survey findings, and end with a dedicated Q&A portion. Attendees are encouraged to submit any questions through the chat feature during the presentation, and we'll answer those during the Q&A segment. All registrants will also receive both the presentation deck and a recording of the session via email by Monday. So to introduce Corporate Insight, we've been an industry leader since 1992, researching digital experiences for as long as they've been available. We serve leading financial service and healthcare firms, providing the intelligence they need to build best-in-class customer experiences. What makes us unique is our ability to combine customer insights with industry expertise. We analyze the user experiences of over 200 institutions, delivering recommendations that help you make data-driven decisions. Our research shows what it's like not only to be your customer, but also your competitor's customer, helping you improve your experience and gain a competitive advantage. Our services span 5 key areas. First, our Monitor research services, which include Fintech Monitor featured today. Second, our experience benchmarks, which provide comprehensive annual studies with quantitative scorecards and strategic recommendations. We also offer 3 customized services. These are custom research projects, UX research, and quantitative research. These are all designed to provide tailored insights that drive business growth. These services also help support our ongoing research. For instance, the survey we'll be discussing today was developed by Fintech Monitor alongside our quantitative research team. Our Fintech Monitor is a unique offering due to its wide industry scope. So we track fintech firms across banking, credit card, brokerage, crypto, person-to-person payments, and buy now, pay later. Some of our core firms we monitor are listed on the right, but we also frequently include other disruptors or incumbents when they add value to our analysis. We publish industry updates every month that review major digital changes and product enhancements from the firms we track. Each month, we also publish a firm profile or a deep dive report. Each profile looks at one fintech top to bottom, assessing its strategy, branding, positioning, along with calling out some of its unique digital capabilities. Recent examples of these include Apple, PayPal, Credit Karma, and Monarch Money. For our deep dive reports, we'll pick a topic and compare fintechs against each other. Recent topics include account opening and customization and personalization. We also include data from proprietary surveys to kind of contextualize our ongoing analysis and offer subscribers current views of behind the login fintech digital experiences. I want to provide a bit of context around the survey. Corporate Insight works with many of the large incumbent banks that are concerned about the competitive threat posed by fintech disruptors, especially when it comes to acquiring young customers and then developing lasting relationships with them. So we developed this survey to understand how consumers make choices between fintechs and traditional accounts. For example, what drives a consumer to open a fintech or incumbent account? What elements of their banking experience are they satisfied with? and what might actually prompt them to make a change. By answering these questions, our research provides actionable insights for both traditional banks and incumbents. For incumbents specifically, we've identified opportunities to strengthen their position while leveraging their existing advantages. So now I'm going to dive into our research methodology. So in Q1 2025, we surveyed 972 bank account holders, classifying them into three distinct groups. Fintech-only respondents, those who bank exclusively with newer digital-only firms like Chime or SoFi. Incumbent-only respondents who bank solely with established institutions like Chase or Bank of America, and then combination respondents who maintain both fintech and incumbent accounts. We also analyze trends based on age, preferred platform, and household income to uncover meaningful patterns across user segments. Something that will come up throughout the webinar is that participants rated the importance of and their satisfaction with features using a 5-point scale. The term top 2-box importance or top 2-box satisfaction refers to those selecting the highest 2 ratings. To begin, we'll look at account opening and account satisfaction broken down by respondent type. So this slide demonstrates the difference in customer tenure between fintech and incumbent users. Over 2/3 of fintech-only respondents opened their accounts in the past 5 years, with the largest increase coinciding with the pandemic. On the other hand, nearly half of incumbent-only respondents have had their account for over a decade. For fintechs, the challenge will be to retain these customers as they age and their financial needs evolve, especially if they begin to value features like branches or more comprehensive service offerings. For incumbents, the challenge is to retain long-term customers while pivoting to attract consumers drawn to fintech alternatives. The financial tribalism myth. The pie chart on this slide shows that half of fintech-only customers still considered traditional banking options. That 50-50 split reveals fintech-only customers aren't rejecting traditional options entirely. They're making deliberate choices between the two based on their specific needs. Looking at the income breakdown on the right side here, it contradicts the conventional idea that fintechs most effectively target lower income consumers. For fintechs, this means it's not just the more affluent, for incumbents, this means it's not just the more affluent fintech users that considered your products, but users across all income levels. Traditional banks have proven they can attract fintech-oriented customers, but they have to identify and address the specific factors driving consumers to choose alternative banking options. On this slide, we can see the factors that all respondents would consider when opening an account. We found consumers value a mix of tangible product elements, convenience, and socially significant factors. No-fee accounts and recommendations from friends and family were leading considerations. Other monetary factors like no-fee ATM access and account opening incentives also ranked highly alongside personal elements, such as brand familiarity. The balanced consideration here of practical and social elements demonstrates that account opening considerations aren't purely economic. Social and personal values also play a significant role. Here, we see a contrast between those selecting traditional or fintech banks. Looking at the right side, you can see that 52% versus 20% figure. That's the discrepancy between incumbent and fintech respondents that would consider branches during account opening. Below those figures, we can see that fintech users would consider P2P payments at nearly double the rate of incumbent users. P2P payments have become a way not only to create engagement, but can serve as an entry point into banking relationships and assist firms in cross-selling their other services. So now let's explore how preferences translate to account satisfaction once those banking relationships have been established. So fintech only respondents showed high satisfaction with the core digital offerings, no fee accounts, APYs, spending tools, and P2P payments. However, 16% were dissatisfied with nearby branch access. And that's interesting because these respondents chose digital only banks. It's possible they were unaware their bank did not have branches or that they had some unforeseen reason for wanting to visit a branch. For fintech only respondents, they echoed this sentiment in open-ended sections of the survey. They stated there are no offices to walk into or there are no physical locations, so calling is a hassle. For fintechs, this signals the need to develop solutions for those moments when users might want a branch, whether it be through better virtual support or new services that provide human assistance without traditional branches. For incumbents, the 16% of fintech customers that may actually want a branch represents a potential win-back opportunity. In examining P2P satisfaction, this slide highlights somewhat of a vulnerability for traditional banks. On the top right, we see that while 92% of fintech-only customers were highly satisfied with their P2P payment capabilities, just 74% of incumbent-only customers felt the same way. There's also a clear divide among incumbent-only respondents. There was a 26-point gap in P2P satisfaction between incumbent users that use their mobile app for banking and those that use their desktop app. It's larger than a single feature. P2P continues to evolve into a way that consumers, especially younger ones, interact with finances on a day-to-day basis. When consumers choose Venmo or Cash App or PayPal, they're not just choosing a new payment method, they're also establishing a new financial relationship. In looking at incumbent-only respondent satisfaction, they were highly satisfied with items including their website or mobile app quality, customer support, or branch access. However, satisfaction dropped significantly for APYs and deals or offers. This APY dissatisfaction highlights a concern for incumbents. Many incumbent users noted this issue in open-ended responses, saying they don't pay a lot of interest or the interest I get on savings is too low. This creates an opportunity for fintechs to acquire savings balances from dissatisfied incumbent users and then cross-sell additional products. So before moving on to the next section, I just want to pull out a couple key takeaways from this. Firstly, while consumers are increasingly opening fintech accounts, half of them considered an incumbent account, meaning traditional firms still have a real chance to attract these users by capitalizing on social factors. Second, respondents were satisfied with different account elements based on their user type. Incumbent-only respondents showed high satisfaction for branch access and customer service, but were less impressed with P2P functionality and their APYs. Fintech account holders, on the other hand, liked their bank's APYs and P2P options, but some were disappointed with their bank's lack of branches. Next, we'll look at account opening and satisfaction by generation. Through the map on this slide, you can see the most common reasons for account opening by generation. The shading shows how common answers were, with dark green representing the most selected reasons and dark red being the least. Looking at the patterns, we can identify a few trends. First, Gen Z respondents were more likely than other generations to consider social aspects, like recommendations and bank values prior to account opening. Aside from this, though, Gen Z respondents had few areas of strong interest or disinterest, possibly because they are still developing their banking preferences. Boomer respondents, on the other hand, place strong emphasis on features that build institutional credibility like branch access, like customer service, and established brand names, while they show the least interest in digital tools. They were also more confident in what they value in a bank provider, as you can see with the level of shading in that boomer column. This map doesn't just highlight different preferences, it also reveals there's a variation in banking values that firms should consider. This slide explores a counterintuitive finding regarding fee sensitivity among different generations. So, while many think that younger, lower income consumers would be most concerned with fees and then motivated by monetary incentives, our data actually reveals the opposite. Gen Z was far less concerned about account fees, no fee ATM access, and account opening incentives when compared to the general respondent pool. This shows that younger consumers don't necessarily want free banking, but want banking that's worth paying for. That fee sensitivity finding highlights a real opportunity for financial institutions. Gen Z is used to paying for premium subscription models that deliver superior experiences. We're seeing fintechs capitalize on that trend as we track their digital and product updates for Fintech Monitor. Some fintechs now support subscription services that bundle additional features, higher rewards, and exclusive benefits. So Rocket Money offers a premium subscription, which costs between $6 and $12 a month. Interestingly, users actually choose the amount they wish to pay within that range. The subscription unlocks app features such as bill cancellation services and expands other services, such as allowing premium users to create an unlimited number of budgets. And that's working. In Q4 2024, Rocket Money had over 4.1 million premium subscribers. Moneyline also supports a paid membership, which is called Moneyline Wow. It costs $9.99 a month and includes things like higher cash back, purchase protection, and weekly giveaway access. And last but not least, Robinhood, which offers a gold subscription of $4.99 a month. While most of its benefits are geared towards brokerage users, it also provides deposit boosts for banking users. This represents a potential revenue diversification opportunity. As Gen Z becomes the dominant banking demographic and has more money to spend on premium features, financial institutions that maintain only their messaging around free banking may miss this value-based consumer pool that are willing to pay for meaningful benefits. To further assess the generational differences that are at play here, this slide shows us the account opening elements considered by boomers and Gen Z, highlighting a shift from institutional to social trust. So for boomers, branch access and access to customer service representatives remain highly important account opening considerations. Gen Z, however, is uniquely motivated by social recommendations and bank values, as they view banking decisions as an extension of their identity. Financial institutions that can maintain institutional credibility while building on their social values may effectively capture market share across these generations. Given Gen Z's emphasis on relationships and values, many fintechs we track for Fintech Monitor are embedding these elements directly into their digital experiences. So here are some examples of this. Moneyline offers a social feed where users can engage with friends or other users, share financial tips, discuss financial and non-financial topics, which creates a community around money movement. Green5 focuses on climate-friendly values by encouraging tree planting, showcasing eco-friendly brands, and highlighting climate relief efforts to connect the firm with this positive environmental impact. Similarly, Klarna promotes sustainable shopping practices, climate-conscious brands, and quantifies its own positive environmental impact to make those values visible within its digital experience. These social and values-based features work to entice younger consumers who, distinctly from past generations, want to see these values and their community reflected in their financial relationships. Still, younger fintech-only respondents are not totally wowed with their fintech banking experiences. Here, we can see the percentage of fintech-only respondents who were extremely satisfied with various account elements, and this is broken down by generation. This satisfaction gap is significant. While 88% of older generations, Boomer and Gen X respondents, were extremely satisfied with spending tools, only 40% of Gen Z respondents felt the same. Similarly, 81% of older generations were extremely satisfied with their bank's website or app design, compared to just 40% of Gen Z. This suggests that younger respondents have higher expectations for digital services, as they're accustomed to more cutting-edge apps and customer service tools, even outside of financial services. For traditional banks, this means there's still room to be better at meeting Gen Z's higher expectations. In looking at some takeaways on these generational divides, older respondents valued practical account opening elements like fees and branches, while younger consumers were far more concerned with social factors. Younger respondents, especially Gen Z respondents, were less concerned with fees, signaling they're willing to pay for premium features and services. Additionally, Gen Z fintech-only respondents were about half as likely to be satisfied with digital tools, such as the bank's website, the mobile app, its spending tools, and even customer service. Moving on to our next section, we wanted to understand what would incentivize respondents to actually change bank accounts. As you can see on the left, 80% of incumbent-only respondents had not considered a change. Of this group, Boomers were overwhelmingly opposed to changing banks. 91% hadn't considered it, which is shown on the right. This is because older respondents have had more time to find a bank that meets their needs, or that they would have already switched if they had issues. They may also have long-standing account relationships with an incumbent, deterring them from leaving. Middle generations, Gen X and millennial respondents, were most likely to consider a change. Gen Z respondents, however, were a bit less likely, possibly because they haven't really had that many banking experiences and may not have run into frustrations with their bank yet. So thinking about that 80% of respondents that hadn't considered changing banks, it ties into a real push we've seen from firms in the Fintech Monitor cover set. We see so many firms incentivizing direct deposit relationships via various perks, and here are a few of many examples. Dave offers users their paycheck funds 2 days early, which is a common fintech incentive if they enroll in direct deposit. SoFi Plus is available for either $10 a month or is free for direct deposit users. The membership includes a higher APY and credit card rewards, as well as unlimited one-on-one financial planning sessions and a match on recurring SoFi Invest deposits. Vero also offers early payday, along with an increased APY, cash advance options, and faster customer service for direct deposit users. And as we know now, it makes sense why these firms are pushing so hard for this direct deposit relationship. Once users bank primarily with a firm, it seems like they're quite unlikely to change that. In terms of reasons why incumbent account-only respondents hadn't considered changing banks, far and away the most common reason was that they liked their bank. And you can see this broken down by generation on the right. It was a bit surprising, as many typically think of the effort it would take to move a direct deposit account and all the bills that could be linked as a large barrier, but that factor was considered far less. Other top considerations, although less common, were low fees and physical branch access. Walnut displayed 12% of Gen Z respondents cited having no reason to switch, more than double that of Boomer respondents at 5%. Signaling, again, that they have different account opening preferences and satisfaction rates than other generations, yes, but Gen Z is still learning specific factors that they want in a banking provider. Now, for those respondents that did consider leaving their bank, what was their reason for considering leaving? This graph shows the percentage of incumbent users that selected the following reasons. Generally, incumbent-only respondents considered leaving for monetary reasons, so those being deals or offers or account fees. Access to a physical branch was, again, also valued highly. Looking at that percentage of respondents that would consider leaving for a higher APY, it's a bit of a contrast. Many incumbent-only respondents were dissatisfied with their bank's APY, and that made that clear throughout the survey. But only 12% said they would actually consider leaving their bank for a higher APY. So, how do respondents even find out about bank offers that would entice them to leave their bank? Well, search engines were largely the favorite for incumbent users, followed by financial sites like NerdWallet. While Gen Z did not consider monetary elements as much as other generations when opening their accounts, 71% of Gen Z respondents said they were aware of competing bank offers, the highest awareness of any generation. Boomer respondents were least likely to know of competing bank offers at 29%. Social media also ranked quite highly as a method to see bank offers above more traditional options like recommendations from family, friends, financial advisors, or colleagues. So, what generation was most likely to see banking information on social media? You probably guessed it was Gen Z. 43% of the generation stated that they saw banking information on social media. No other generation was above 23%. While Gen Z finds offers on social media, yes, they're less motivated by standard checking account promotions they might find it, such as account opening incentives. Some key takeaways from this section. Most incumbent respondents did not consider changing banks, and the most common reason was that they liked their bank. Also, only a few respondents were deterred by the effort it would take to actually change banks. Gen Z respondents were the most aware of competing bank offers, and boomers the least. Additionally, Gen Z found information via social media more than any other generation. And although not satisfied with their APYs, most incumbent-only respondents did not consider leaving for a higher APY. In fact, they were more likely to consider leaving their bank for better branch access than a higher APY. In our final category of questions, we asked respondents what they used their accounts for and how they accessed those accounts. So every segment across generations, across user types, leveraged their bank's mobile app more than its desktop site. This was especially true for younger respondents. On the right, we can see mobile app versus desktop usage across segments. Younger generations seem to prefer their mobile apps. Older generations maintain a higher desktop usage, but only comparatively. This data suggests a pretty clear shift towards mobile-first banking. But desktop sites may just be becoming more specialized. Many people use their mobile apps to check balances or transactions, but log on to their bank's desktop site for more intensive banking tasks when they arise. So, while respondents log in more via their mobile apps, it's possible that desktop experiences are just as critical to meeting their overall banking needs. It's important for firms to identify the high-value actions that consumers do perform on desktop and ensure they're eventually comfortable performing them on mobile. The large gap between Boomer and Gen Z respondents with their mobile preferences shows that banks have a closing window to improve mobile experiences as desktop usage continues to decline. We also wanted to know what respondents use their different accounts for. We can see that account usage by category for combination respondents here. Incumbent account usage in the dark blue bar and fintech account usage in that teal bar. Combination respondents favored their incumbent account by tasks by an average of 21% per category. Particularly, combination respondents strongly preferred their incumbent account for things like paying rent and making credit card payments. For respondents that might bank and have a credit card or loan with a firm, wanting to make payments with that same bank internally might contribute to that trend a bit. Combination respondents only favored their fintech account for one surveyed element, and that was making P2P payments. We can see this highlighted in the bottom row. It seems combination respondents only find their fintech most useful for P2P payments, which is a good signal for incumbent firms. However, these fintechs have their foot in the door and will look to expand these account relationships. This P2P payment discrepancy was certainly driven by firms such as Venmo, PayPal, Cash App, which began innovating in the P2P space before Zelle was launched in 2017. A couple key takeaways from this section. First, respondents across generations, across user types, log on to their bank's mobile app more than its desktop site. This was especially true for younger respondents and those using fintech or combination banking services. While mobile apps are becoming more common for banking experiences, desktop apps are becoming more specialized. Lastly, combination respondents favored their incumbent account for tasks by an average of 21% per category. These respondents only use their fintech account more frequently for P2P payments. And that brings us to the end of our presentation. Thank you all so much for attending this session and listening to our findings. Now we can move on to our Q&A and just answer any questions you might have. Someone asked, how does CI define a fintech compared to an incumbent? So we define fintech as a digital-only financial services firm, typically founded in the 2000s or later. Most of the fintechs we track for Fintech Monitor were established after 2010. These are disruptors that are kind of challenging the financial services status quo, such as Chime, SoFi, PayPal, or Cash App. Incumbents are more established traditional financial institutions that typically have in-person branches and kind of are that status quo of financial services. Do you have market share data in terms of the percentage of accounts which are being opened with a fintech first traditional branch? So, and then also market share data for assets going to fintech first traditional branches. So we don't track that data ourselves, but are aware of research from Cornerstone Advisors that showed that 44% of checking accounts were opened with digital banks and fintechs, actually down from 47% in 2023. Comparatively, big banks and regional banks, they accounted for 43% of new checking account openings in 2024. So those numbers are obviously pretty close. Those new accounts are not necessarily users' primary accounts. People may be opening accounts to sample digital tools or for specific use cases. The next question is, I'm curious about what customers found lacking in P2P, in incumbent P2P options. So I will say in open-ended responses, respondents did call out like ease of use and specific use cases like business transactions, which are available in PayPal and Venmo's apps. I'll also say that in a lot of these fintech apps that were originally, the P2P functionality was the cornerstone of the kind of app structure, and they take up kind of the P2P functionality takes up central real estate in those apps. Maybe comparatively, incumbent apps kind of a lot of their P2P functionality is presented next to or even behind some services. Okay, were there any other recurring sentiments in the open-ended section? Yes, yeah. So for fintech respondents, a theme that came up repeatedly was ease of use, be it like the app itself or account opening experience. Numerous respondents noted that the experience is easier or user-friendly in some way. Um, Incumbents, on the other hand, we saw several respondents note that having a nearby branch or customer service quality were things that they liked most about their account. Do we have any info on why fintech-only respondents wanted branches? Easy account opening seems top of mind. Um, and it seemed like we had a couple of open-ended responses were that equated the fact that they didn't have a branch to now they had to call. So it seemed like customer service issues also seemed to be a main reason why people wanted to visit a branch. Question. Okay. Any thoughts on the staying power of P2P fintechs as a checking account? Thinking specifically of Cash App, who does really well with the youngest group. But do you have to think that accounts won't be sufficient as customers age? Yeah, I mean, that's the big question. Can fintechs build on what they have now? Well, definitely Fintech Monitor will be tracking that closely for months and years to come. I think the question becomes is can you effectively cross-sell the users that are currently using your P2P services and maybe your checking account, and getting them to move primarily to Cash App if they aren't already, cross-selling their existing services. You mentioned Cash App. Cash App also has Cash App taxes and investment functionality, and you can buy crypto on there. So becoming more of those users' financial epicenter of their financial lives will be key for them. What surprised you most from these research findings? Yeah, I think for me, it was definitely the younger generation's lack of concerns about fees was pretty surprising. You typically think of younger, lower income people as being more concerned with monetary factors when opening financial accounts. So it was interesting to see that they were actually more willing to open checking accounts based on what their family or friends thought than the monetary factors involved. Is there any indication by generation what role they prefer money to play in their life? It's a big question and a good one. I think generally we got the sentiment that there was such an emphasis on P2P for fintech users and younger users. Kind of, it seems that as you get older, you get more involved maybe in your finances and value different things in a banking relationship. And just this element of being able to pay your peers and friends quickly and easily seems just so top of mind for younger consumers and fintech consumers in general. And I think I was surprised by the level of that played into their decision making. Okay, we are wrapping up. Please feel free to reach out at these contact points and that are on the slide, and we're happy to answer. Also, please contact us if you're interested in learning more about Fintech Monitor or Corporate Insights other services. Thank you so much.